Capital's exclusive analysis. In today's video, we're discussing the weekly review of all of the S&P 500 sectors. We're just going to do a quick run through, not going to dive into too much detail on each sector, but just looking at each technical chart. Dow Jones Industrial at some near-term support, hitting the 20-day moving average for the first time since you had that bull market run. The Dow Jones Transports also appear to be trying to break down below some of the key critical moving averages. Really, your 50-day moving average is probably your next big support. You can clearly see that upsloping parallel channel where you're just fluttering right now, technically above that zone. If this turns into a right shoulder, look out below. The transports could break down, and that likely could be that oil potentially going higher. Retail stocks approaching the 200 moving average. Last time we teched back to this area, look what type of bounce you got. You got a higher high bounce. Will we get a higher low? Look for a potential bounce in these names. Regionals not looking good on the weekly chart. Take a look at that daily chart breakdown. Although you are hitting the 200 moving average since the last time you broke out above it here, look for a bear pattern. If this forms a bear flag or a bear wedge, this is going lower. It likely has a downside target of between 40 to 43 bucks on the charts. Materials, XLB, seeing its first pullback in its strong technical breakout trend. Look at that chart. Beautiful technical breakout out of this massive bullish wedge pattern that really started back in 2021. So we're talking about a multi-year consolidation. This likely has an upside target to 108.72. We discussed not buying this breakout, waiting for the retest. So now you can be a breakout buyer instead of a breakout seller if you miss this. So as of now, I still think that materials are getting a little bit oversold. This is the first pullback in its breakout trend. But look for that 50-day moving average to act as very, very strong support in the near term. So that sector's on watch. Communications still looking a little bit toppy and distributive in this price action. I still think we're likely going to head a little bit lower. One of the reasons why is we did have a technical breakout on the weekly chart, which likely signaled a new all-time high in XLC. But we're really starting to see some sellers emerge both on the daily and the weekly chart basis, and you're finally breaking below that key 20 moving average for the first time since you did in this little bit of a consolidation period. So watching this technical pattern for more downside. I think that if we start to lose this 20-day moving average on a confirming basis, you're likely going back down to the low end of this bull flag range. Remember, this is your high end here that we're just consolidating above. If we lose that, I think we're going to the low end. We're at about 78.15. Looking at XLE, that still manages to look ferociously strong. One of the reasons it had a nasty pullback. Look at this trend line, pivot high to pivot high to pivot high. This is why trend line and TA works, because you often get near-term pullbacks into massive resistance zone. This one's now shaping up to potentially put in weekly inside bar consolidation to break out of this pattern. I mean, if XLE breaks out of this pattern, which it's actually trying to break out of an ascending, triangle pattern, one could argue even this uprising bull flag pattern, this has had a monthly chart breakout. You're looking to confirm this candle in the next 15 days. If that confirms a monthly chart breakout, I mean, I don't know what oil is going to do. Perhaps that's signaling more escalation in the Middle East, higher inflation. Who knows? Maybe the SPR is forced to restock at much higher prices, which causes the oil price to go even higher. Remember, we have had Biden deplete oil in that round one of inflation, and it was expected that interest rates were likely going to tame inflation in the near term, but it wasn't really. Inflation wasn't coming down because the tightening cycle was working. The Biden administration was completely depleting the Strategic Petroleum Reserve, which is why energy is starting to be so strong and outperform everything. And this is a dangerous scenario, is because if energy starts to outperform, there's been many scenarios in history where oil starts to spike out of control, and that naturally is one of the heaviest forms of tightening on the overall equity markets. It's very rare to not see the markets come under immense pressure if oil is starting to spike. I mean, look at this 08 run, right? Spike on USO. Now, we're not going to go back to those highs just due to the decay in the CTF, but it just shows you the type of runs that energy and oil can likely continue if it gets some political backdrop to help it, which it certainly has, some geopolitical backdrop to help it, and then the inflationary measures. And then ultimately, people are still coming into a seasonality period where we're likely going to be spending more. Moving along, financials got absolutely slaughtered on the brink of higher inflationary expectation and higher interest rates. Look at that. I think JP Morgan was the most telling one off of its earnings gap down. We're talking about the biggest bank in the States here, And look at that massive gap down. Huge decline on Friday, closing down 6.47% on 31.5 million shares. That's huge. That's a massive technical breakdown. And ultimately, I really didn't think, I was very shocked that JP Morgan actually got through this first technical resistance, this pivot here to this pivot. I thought we were actually going to get stopped in and around this 185 range, and it managed to squeeze all the way up to about 201, just slightly missing. I thought we were going to get stopped at this long-term trend line all the way back from 2000 to your pivot high, but it managed to blast through that. And I mean, it's just crazy how sometimes these stocks can just continue to squeeze based off of momentum, but not healthy price action in financials. Are they getting a little oversold? Maybe they are in the near term, but I think that these could likely move lower. Industrials pulling back, probably the 50 days your best support. XLK still looks like in a potential bear range here. Notice how XLK is still holding okay because this is heavily weighted in Microsoft. So right now you have Microsoft skewing things in favor for the NASDAQ, in favor for XLK, but you're actually seeing some broad market selling take place in the semiconductors. The semiconductors have arguably been your more stronger sector ETF, and they're actually got that daily chart breakdown below this wide range red bar breakdown in comparison to XLK. XLK is showing a little bit more relative strength, still holding that wide range red bar breakdown. You haven't really confirmed, but I do think that the problem is that the world's biggest company, Microsoft, could be the next leg lower in the near term. Staples absolutely having a massive technical failure here. Coming into some support though, and the Staples aren't really done and dusted at the moment, but they are coming up into some technical support. You can see on the weekly chart, look at that close. You close right on the 20-day moving average. You still got a bullish crossover of the 20 through the 2, through the 50, and through the 1. So as of now, this is expected to bounce. I would keep this sector on watch for a potential bounce next week. I do think it's undergone quite a bit of stunning. So take a look at some of the stocks and look at their charts into some of the key daily moving average and weekly moving average for a potential bounce. If you look at real estate, that one's looking like a massive problem is about to unfold. You're hitting the daily 200, but you actually got to close below that on Friday. Take a look at this big technical potential failure that is occurring in the overall real estate sector. You tried breaking out here. Now you're having a potential failed breakdown, which could take you all the way back down to about 33, 34 bucks on the charts. You've broken a little bit of a mean trend. If you break this pivot low on real estate, watch out. Watch out for especially the commercial side. All right, utilities, let's quickly move along to that. Utilities having a pullback potentially could go down to about the 50 and the 200. Keep in mind, utilities just got a golden cross, the 50 and the 200, just intersected in an uptrend. That likely shows in the near term and medium term that this breakout is still going to hold. We did have a daily chart breakout, which was confirmed not only by one candle, but a second daily high candle here. Now you're just selling off, shaking out weak hands. I still think that this sector will likely move higher. A nice 2-week pullback, inside bar consolidation from that breakout candle, consolidating right under that weekly 200, and the market's been exceptionally weak. Yields have been exceptionally strong. Dollar's been ripping. Oil's been ripping. So utilities, in the grand scheme of things, haven't really broken down in the technical picture. So look at utilities, watch for bullish flow and bullish price action. The next bullish sector to watch for is XLV. We were discussing this potential retrace, so we're going to go to the weekly chart. Weekly chart of healthcare here. Trendline pivot high to pivot high to pivot high. You basically have your bull flag wedge pattern that was formed over just roughly 2.5 years here. You broke out to the upside with clear conviction, confirmed on 1, 2, 3, 4 weekly candles to the upside. Now you've done a full-on retrace. This was your target. Not only are you hitting the back top of this wedge pattern, but you also have a Fibonacci extension move with 382 fib level sitting at 138.53. And that's your high, that's your low pivot to your high pivot. So a couple different factors here on the daily chart. You have pierced below that 100. I naturally expect healthcare to probably retest this 142. And there's a potential, if the indices confirm up, this could actually try to retest this double top here, or even this low bull flag consolidation window here. So I do have an upside target. I think that healthcare stocks can bounce. XLY, so consumer discretionary, closing on that daily 100. This is Amazon and Tesla. I still think that this can actually fall a little bit lower, basically retesting this 171 level. I think that there could be a little bit more downside in Amazon. Amazon's had a massive extension move into this double top resistance. This pattern is likely going to potentially fail here. You can even see that you found some sellers. You tried breaking out. You actually set a new all-time high price in Amazon. My girlfriend must have been buying a lot of stuff. So ultimately, I think that there's going to be some sellers. Your next support is back down to about 178-ish, but Amazon certainly setting a new all-time high last week does leave it vulnerable to potentially seeing some downside. You're putting in a negative divergence here on the RSI. What I mean by that, lower highs so far, but your price action is putting in higher highs. This is still a very, very big resistance level. Maybe you do another little peekaboo above, but I expect that Amazon should have some lower boundary consolidation. As for Tesla, you look at Tesla's trying to actually firm up off of this key support level. But in the grand scheme of things, yes, the daily chart, could you move up a little bit more? Sure, you could. But in the grand scheme of things, people are looking at this as a daily chart breakout. What I'm seeing is still lower highs, lower lows, and look what's potentially unfolding, a weekly chart bear flag. You got that heavy weekly red candle bar close below this weekly reversal signal, and then you confirmed it. And now you're just chopping and distributing in the last 4 weeks. This is a bear range. I still think Tesla will have another move lower, especially if the market is weak. So pay close attention to this name because it does fit the criteria that XLY goes lower. Let's quickly do a speed round through some of these healthcare and utilities charts. I'm not going to look for buy recommendations or sell. Starting with healthcare, we're just going to quickly go through some of the leaders here. Just scrolling through quickly. J&J, massive breakdown. Looking for further downside, but getting oversold. Look at what it's hitting, the weekly 200 moving average. Last time we hit this through COVID, we pierced it with significant margin. Look what happened, massive rebound. Let's keep going. J&J, Merck, still strong. Eli Lilly, distributing. Pfizer, so oversold. Just wants to go lower and lower. No one likes it. AbbVie, big sell-off. Thermo Fisher consolidating. DHR consolidating. Big breakdown. BMY. Gilead getting extremely oversold on the weekly chart. Still consolidating. CVS looking to go lower. Medtronic, potential bullish accumulation pattern unfolding. Inverted head and shoulders. Needs more data. Regeneron selling off from all-time highs, hitting and piercing your weekly chart support. Likely will get a bounce very soon. Amgen still selling at support. Bear flag on BDX. Humana, massive technical breakdown, but at huge support. So those are some of the names that I do think that there's some potential opportunities across the healthcare space. My members obviously know what I'm looking at and what I'm entailing. I do have a couple other ones that I haven't mentioned that I'm very close to potentially executing some buy signals in. So if you're interested in how I'm looking to trade some of these names, definitely check out my website, tradingcapital.ca. If we look at some of the utility-based names that are showing some potential signs of accumulation. NRG, look at that chart. Massive rocket ship to the moon. Holy. Breakout, like clear conviction. EIX, trying to break out off this inverse head and shoulders. PNFP, still showing bullish accumulation above your weekly moving averages. Market's been weak. These sectors are still holding strength. NI, still looking to break out of this weekly inverse head and shoulders. Just scrolling through some of these names. Nice technical breakout on PEG. So again, I would encourage you to go through some of these utility and healthcare charts. Those are looking, this is copper. So that one's had a little bit of an extension move outside of its range. Needs to cool off. I wouldn't chase it. But it just tells you the commodity charts, copper, oil stocks, that's just more inflation on the horizon, guys. That's investors telling you that there's inflation in commodities. And when you get commodity-based inflation, that's a problem, right? Because what we saw in 20, and this is a little bit of an education, what we saw in 2020 that really kind of started the inflation, or we saw monetary side inflation because we printed massive amounts of stimulus globally. And then you're going to have people that argue that there wasn't really any monetary inflation because what happened was we had global supply chains shut down. So it was really the service side and the good side inflation that reared its head because there was all this pent up demand from people not spending. And then all of a sudden you had this influx of stimulus that caused people to spend, and then the global economy started to come back from lockdowns and reopen. So we haven't really seen the commodity-based inflation that I think we're witnessing right now. You're seeing it across the board, right? Copper pushing to new highs, trying to push for new highs. Gold, silver, uranium, Bitcoin's done it if you're considering that a commodity. Oil is now pushing. So commodity-based inflation can get out of hand if it's not nipped in the butt quickly with tougher economic policy. And obviously Powell didn't come out too hawkish the last time he spoke. So maybe he's going to flip his tune on Tuesday. Again, Tuesday, Powell speaks. So again, I'm looking at a lot of these sectors that are coming into some support, but there's a lot of weakness still potentially unfolding in this market based off of interest rate expectations changing from 7 rate cuts at the start of the year now down to 1. What happens if the bond market starts to produce and price in a rate increase of, say, another 1 or 2%? I mean, it's unlikely that we're going 2%, but maybe another quarter basis point hike, maybe another half a basis point hike. That would certainly surprise the market, and that could actually start to nip inflation more so in the butt. But it would certainly cause a lot of pain across equity markets and the bond market, more importantly. On that note, thank you all for tuning in. Please give this video a like down below if you felt it useful. Take care, and we'll see you all next week.